Welcome back to Reimagine 2021. I'm Yonah Hochhauser, and today I'm glad to be joined by Luca Cosentino, Product and Go-to-Market Lead at Oasis Labs. Luca, thanks so much for joining me.
Oh, big pleasure to be here. Thanks for having me again.
No problem. Well, Luca, we spoke last time, and I really enjoyed our call. But maybe for the viewers who didn't get to see the first one, give us a quick background, kind of who you are and how you got into blockchain.
Yeah, happy to. So working product, I've done product or product related functions for my entire career. Started off starting my own company in the ad space before kind of realizing that a lot of the ad business was moving online in a much more like demonstrable way. And yeah, I gradually approached this world of like understanding the users, understanding the final customers. I've worked for big companies, heavy on process and heavy on existing businesses. So I worked for Procter & Gamble, American Express, and Google. And I've been receiving my MBA from UC Berkeley, which is also where I started getting a little bit more serious about the blockchain space. But what's also interesting is that I started playing with Bitcoin in 2013. At that time, I was an intern at a payments company, and yeah, I read about Bitcoin, and I was just interested in this like new thing that was getting this bottom right corner of a newspaper, and I was like, what is this? Like, why do people give some attention to this thing, which doesn't have a concrete use case attached to that, at least from the words of that newspaper. Um, and so I went to my managers and said, hey, listen, there is this thing that is happening, it's decentralized. I don't know exactly what this means, but there is no company attached to that. Can I spend a little bit of time like researching what this is? And just to give you some context, like the price of Bitcoin was $200 at the time. That was the time frame. I think it was 2013, something like that. And these people told me, now, like we looked at that a little bit. We think it's a video game, something that has been like fabricated. We don't really know what to do with that. I don't think it's our business. And it's like, okay, fine. I mean, these guys have like what 20, 30 years of experience. They must know, right? They must have seen others. And I think I would have been rich if it was not for like because of them at this point. But sadly I didn't get serious about Bitcoin. I started playing a little bit with it, but I never got serious into like the tech side of Bitcoin. Like flash forward like a few years, I go to Berkeley, and there's the blockchain at Berkeley community. Like blockchain is much bigger than what it was before, so I started like reading the white papers of Ethereum, and then all the others like layer ones and layer twos that we're growing. And while I was like getting a little bit more serious into this, I appreciated how blockchain could solve some of the like trust problem between entities. And I started thinking about one of the biggest problems that enterprises where I worked for had, which was this idea of like sharing the data, using the data and sharing the data. And using the data, sharing the data could be like either with internal employees or with like external like partners, doesn't matter. But it was always a tension point, right? There is this weird dynamic where the first day you join, you request access to like a lot of tables within the company. You provide an explanation that someone else who's based like thousands of kilometers away from you, without knowing anything about you, like reads one sentence and says yes or no to that permission, right? Gives you permission or not. And I felt that was like somehow off. It was a fake level of protection. And I said, there must be a better way to do that. And I had this, I sort of conceptualized this idea where you can put two data sets together, and you don't necessarily have to reveal the data to each other to be able to use that data. And while I was researching who the experts in privacy preserving computation were, I came across the name of Professor Don Song, which is a professor at Berkeley, and she's also the founder of the company we're working for now. And essentially, what happened was like the match was pretty obvious, felt pretty obvious. Yeah, so she sent me the white paper she was working on, and then a few months later, I joined our company, and since then, I've been involved in all the network aspects. So like taking a project to becoming a decentralized network, as well as like creating this DeFi, decentralized finance vertical, onboarding the partners, like finding integrations, talking to companies, and so on and so forth.
Mm-hmm. Now, I was looking forward to speaking to you because, of all the, I speak to a lot of projects and a lot of big things. And I was excited because you're product lead, you're go-to-market lead. And I feel like in the blockchain space, and we spoke about this a little bit before we started the interview, I feel like it's all about innovation. It's all about these big concepts. And it seemingly, at least on the user end, it doesn't seem like there's enough focus on the user end. There's not enough focus on the UI UX on, hey, could even, anyone, any mainstream person who isn't, big into crypto, could anyone actually even use any of these products, especially these DeFi products? So, when you guys are inside the company as a product guy, has the focus started to become, the mainstream, or is still, when you're building products, it's still focusing on the crypto end user?
Yeah, that's a very good question. And I think there is an intermediate step between these two, like technology or end user, which is the need to explain why the people, like your community or all the people that rotate around your project, need to believe in your project. I think this is one of the missing elements between these two aspects that you mentioned. What I'm trying to say here is that when you think of the ICO part, and again, like we don't have to talk about ICOs. Oasis hasn't run any ICO, so like we're far from that. But the idea of raising capital from people all over the world that has been incorrectly labeled as scam as 100% of the times, which is not. But that idea has been led by putting your technology forward. So you're saying, this is the status of a certain industry that is becoming bigger and bigger. This is like my way to improve that from a technology standpoint. You should give me money to support my development. That was the story in 2017, maybe 2018 as well. Now, the second step to that was, okay, now that we have all this infrastructure there, now that every project has been competing for technology, there is a second layer to that, which is, okay, now that every project seems to be credible, seems to have a good technology behind. When I say every, maybe I mean like even if it's like 30%, it's still 30% of a very big number. The second part of that conversation has become, wait a second, what are your numbers? And this is a fundamental shift, in my opinion, between like the first blockchain wave and the second blockchain wave, which is today, which is more, wait, there are like 100 good projects, 200 good projects. How do I differentiate between one and the other one? Yeah, you can say like the team, the community, all these things matter. But then the step is, how much like transaction fees are you accumulating? How many users are using your product? What or like network? What is the number of wallets that is being created every month? What is the trend? Like how many tokens are held by each of these wallets? What's the level of decentralization? And this, in my opinion, hasn't really gone to, okay, what's the experience for the final user outside of the crypto space 100% of the time? But I think it's a massive step forward there, because it started introducing some more quantitative metrics that then will inevitably lead to the final user in the end. Now, I think you're already seeing this shift. The final user maybe right now is still within the crypto boundaries, right? Still there, but I think the question is getting more and more frequent on like, how do we expand that pie? And I bet you're gonna see this with all this like layer one and layer two apparently competing, but in reality like expanding the cake for everyone, trying to do more and more stuff to bring the end user. A lot of steps are needed. The current stage doesn't allow to like expand and abstract from the crypto users, because there is a risk profile that these users need to onboard anyway. But I think the step is really happening now, and will happen soon.
There seems to be a couple of scenarios, or obvious scenarios, that could actually lead to that mainstream using of products. We see right now, when is the biggest influx of new crypto holders is when the bull runs, is when mom and pops FOMO in, they see Bitcoin is at a crazy number, and so they buy the Bitcoin. And so some people say, hey, when will we actually start seeing these end users? is when all these people who just already had Bitcoin, so now they're exposed, they got this idea, oh, it's not a scam, I hold it, it's real. I'm starting to understand this product a little more, and then they'll get curious and they'll want to turn some of their Bitcoin into more Bitcoin, or they want to invest in an altcoin, so they'll start trying out DeFi and yada, yada, yada. That's kind of how I got into it. On the other end, there are people saying, no, when the technology, the underlying technology becomes so seamless that, hey, that now their banking act is run on a blockchain and they don't even know it. So do you think we'll actually ever see that first point? Do you think we'll ever see the point where users are like, oh, I'm using this blockchain app, or will it just be like most other underlying protocols and technologies, that this technology will power a lot of our applications, but the user will never know it?
So that's a very good question. I think it would be a combination of these two, right? I see three big categories. The first one is buying and selling. And I don't think that the fact that PayPal has enabled has brought like the word Bitcoin, Ethereum, and a couple of others to I think it's like 350 million consumers all over the world. By the way, I think it's still in the US only, but okay. Yeah, but like forget about that for a second. Like the fact that they bring it to millions of people, of course, is increase the credibility of those projects. But frankly speaking, I don't take it as a sign of adoption. I think that's a sign of adoption within the investment lens, at least, right? I think if I ran a test today, or like a survey asking, have you ever thought about paying with Bitcoin, to the people who are buying and selling Bitcoin by the PayPal app, the answer yes would be like really low. And I think that's totally fine. It's not a sign. It's not a problem. It's just a different way of using a certain product. Now, this is one aspect. The second aspect is that, yeah, at the same time, the fact that you're playing with it a little bit and you haven't been scammed, the fact that PayPal has invested some money, all these things, I think is a good sign of trust. And so trust will eventually lead to the next step, which is, yeah, now that I trust it as an investment, I can also trust it as a way to use this, to use this medium of exchange, assuming that this is the use case that we're discussing here. And I think the point is, the question is, why should people use these like cryptocurrencies as a way to do something? And if the answer is, yeah, it removes friction, it decreases costs, I don't know, like whatever benefit, if the benefit is clear, I think people will be like more and more like prone to use that. And by the way, there is an innovation curve that starts with like the innovators and then expands. So I think we're doing exactly what the protocol says. But at the same time, I think the third scenario that you were referencing before is also extremely important. And I tend to think that will happen before the user use case, which is under the hood, there's going to be something that will be powered by cryptocurrencies, but it will be denominated into dollars, but it will also be used in an abstracted way, right? And you're already seeing this because the first consumer-friendly decentralized finance banks, even if they are powered and they're running on like decentralized protocols that uses crypto, that uses like the compound tokens, like the C tokens and all these things, tend to just report everything into dollars, and you don't have to care about anything else. Like even your balance on PayPal or on BlockFi or on all these apps tend to like put your dollar value forward and not necessarily your crypto value forward. Same in B2B payments, for instance, you're seeing like the first applications that are thinking in crypto terms, but exposing to their customers, to their users in like dollar terms. So they're abstracting the complexity, and at the same time they're reducing the volatility, or they're reducing the question marks that people may have when dealing with a crypto product.
Mm-hmm. Yeah, I mean, it seems like when there are some industries, I would say even most, mainstream industries, where they see a client need. They see there's a problem that the users face, and so then they build something to fix that problem. And I feel like in the crypto space, it's not really that. It's the opposite way around. It's like, hey, let's innovate however we can innovate. Let's just add as many transactions per second. Let's try to see if we could make sharding a thing, or proof of stake, and then so they do the innovation. and then they turn around to the product guy and say, all right, great, now figure out how users could use this. Is that a fair assessment of overall of the industry today?
Well, I think yes and no. What I mean with yes and no is really like, I think there are ways to support this argument, and there are ways not to support this argument. And what I'm trying to say by this is, yeah, I think there is a sequence of events, right? If you think of the final user, or if you think of the very final product, right, or the final use case, the problem in oftentimes is that you can say, oh, well, wait a second, I cannot do that because I missed that part of the infrastructure. Mm-hmm. And so the question is, if we're talking about the end user, yeah, what you're saying makes complete sense. If you're looking from the point of view of someone who wants to build that final product, you probably need the infrastructure to do that. Mm-hmm. Let's consider an analogy in the fintech world, right? I think one example that everyone knows about these days is like Plaid, right? Mm-hmm. So Plaid is this company that connects a third-party personal finance app, or like a fintech app in general, to the bank of a user, right? So I wanna, I need to, let's consider the easiest example, which is a personal finance app. I need to, I want to get a system that tracks my hidden expenses, right? And tells me if I'm doing okay or not, or if I should get another credit card, and so on and so forth. What's the best way to do that? I need to access the data that sits in your Chase account or in your Bank of America account. And before Plaid, there was no real way to do that in an easy and API-based and standardized format. So the question is, I don't think if you ask any final user, like, do you want to be connected to your bank? They say like who cares, right? But if you want to build a personal finance app and you talk to these people will tell you, I cannot do more than what I'm doing today, which is asking users to input or take a photo or stuff like that, because I lack that piece of the infrastructure. I lack that connection. And in fact, who is the founder of Plaid? Those people were actually building something else, and they realized that there was this gap in between the final app and the banks, and they decided to pivot and build a multi-billion-dollar business based on that. And in DeFi, the same thing is happening, right? You're seeing that, how do I build a investment product if I don't have assets represented on chain, right? So someone will have to build these assets. We'll have to like reproduce these assets on chain for everyone else to build thousands of different apps or supporting like thousands of different use cases because of that piece of infrastructure. Lending, right? Mm-hmm. Compound is always my best example, because they really nailed they build something in the simplest possible way, and they build probably the most primitive piece of infrastructure or building blocks of every financial system, which is like lending, right? Mm-hmm. Like rebalancing surplus and surplus of assets and needs. Yeah, and so it depends on the definition. So I think your question depends on the definition of the end user. And again, to sum up, if you consider the end user as the very end user, yeah, I agree with you. There is a perception that no one is really addressing those needs. But if you look at the needs of the people who want to build apps for these final end users, I think like a lot of the 2020 and even more 2021 are exactly focusing on this piece of the stack. And I think the one thing that I love to see more is, on top of these things, like what's missing is something that protects the final user, like FDIC equivalent, which is something that if something goes wrong, gives you the money back. That part I think is a big barrier to the final user adoption.
Right. I mean, for sure, if you're looking at the DeFi space, I mean, the returns are obviously way higher than you're going to find in the traditional space, but so is the risks. There are many risks, systematic risks, smart contract risks, all type of risks there. And you mentioned there's not much protection. So definitely on the government end, the FDIC, that's the government saying, if you're going to a bank account in America, the government says, don't worry, we got your back. We are going to insure this bank account. But does DeFi need a centralized figure, a government, to provide protection, or we're starting to see some of these decentralized insurance protocols starting to offer that? Could that work? Can decentralized insurance protocols get to the point where people, it kind of replaces the FDIC in the DeFi space, where people, even mainstream users, will feel comfortable putting their money in because they know, hey, if something goes wrong, then I'll get covered by the insurance?
Yeah, so I want to split this answer into two parts. The first part is clearly having a centralized entity that makes that claim. It would be a failure of the decentralized world, because if all the protection lies in a centralized entity, like, right?
What do we do? Yeah, what do we gain?
Yeah, what are we doing here? But at the same time, I think these protocols, like on the insurance side, are doing an amazing job at bridging that gap of protection. But at the same time, they still require a huge leap of faith from the user, because you don't want to go into a place, you don't want to understand the full protocol, you don't want to run the math, you don't want to run the numbers yourself to be able to be insured. And again, who is the person who is ready to put the hours and to study and to research into how decentralized insurance works? Is a crypto person who is also often like an engineer who loves the tech part of blockchain and wants to understand all these like nuances, and is generally fascinated by algorithmically solving problems that are solved by a centralized party in the traditional finance.
Very niche, very niche.
Very neat.
Not a mainstream user.
Right, exactly. Not a mainstream user. And so like, how do you do that? Again, like you can make an argument that this is the same thing when it comes to like value investing, right? There are a few people in the world who wants to take the time, study, build dashboards, build like performance indicators, and then when they have enough conviction, they put a lot of money on a few trades, right? So you can say like, hey, DeFi is going to be only for this niche who's ready to take the time to get a much better payout, a much better system, etc. This is one argument, but I think it would be much more successful and credible if there is a way to, if there was a way to say, okay, this is how the insurance works. You don't have to know it. What you know is that someone else will take the risk of that. So perhaps a centralized, I don't know if that's the right solution, frankly. I'm thinking out loud here. But if there was a centralized entity who is able to give you your payout based on the like, there is one entity understanding all these insurance protocols and then offering like the full protection, I think that could be also like a temporary solution to that. And then progressively decentralize that entity who deals with all the potential problems. Again, I don't know if that's the real solution. It's just something that is coming to mind, like to bridge this gap between very complicated projects in the insurance space, and the final user who wants protection, and that's it.
Right. I mean, yeah. Listen, at the end of the day, in any industry, the end user usually doesn't really do the under the hood research. They just trust the product that works the best, the fastest, the cheapest, yada yada yada, and that kind of floats to the top. So I do think over time, whatever insurance, whichever of these insurance protocols over time prove their worth, that's the one that'll get the users.
Yeah,
but
I think on this as well, if I can say something here.
Yeah.
I think there is also an interesting trend in the fintech space, which is when you consider like this trust that you're saying. Like, my mom doesn't need to know the insurance because somehow she trusts Bank of America, right?
Mm-hmm.
That's the trust that she puts. She doesn't read the paper because she trusts Bank of America. At the same time, the millennials and Gen Z confidence into these like larger institutions, it's plummeting, right? It's a whole-time low. They're looking for additional solutions and so on and so forth. So I think it'd be interesting to see to what extent these new generations will be ready to like take the time and research and study. Maybe we will shift. Maybe we'll see that shift, and studying something will become the norm. I still don't think like like the DeFi space can ask the users to read like stuff for many hours, but maybe there is something in between reading like white papers and so on and not reading anything because you trust Bank of America. Maybe there is a level in between.
Yeah, maybe there's a space for someone to open up kind of this company that boils down kind of what's going on under the hood of each company. But even then, you'd have to trust that middle company.
Right.
Yeah, I mean, it's interesting because we keep on trying to draw parallels between, oftentimes between traditional finance and DeFi, traditional tech and blockchain. And I kind of guess because as humans, that's all we know. We want to compare to what we know. And if you look at the traditional finance space, and we're talking about this technology in the traditional finance space, the real technological innovation, it seems to at first happen in the institutions, and then later on, pretty much only recently, hit the consumers. What do I mean by that? High frequency trading, algorithmic trading, all these, and now it doesn't seem so high tech anymore, but all these more technologies that started showing up in the 80s and 90s and early 2000s, they started off in the institutions. And only recently are we starting to see real innovation in the consumer fintech space, like the Robin Hoods and in these personal finance apps. These things are relatively new. Up for the past 10 years ago, as just a retail trader, you pretty much, your options were limited. You had your trading platform if you wanted, but even that, you didn't have so many tools at your disposal. And in the DeFi space, so far, it seems like all the tools have been geared towards a retail user. Are we going to start seeing more DeFi products built specifically with institutions in mind because there's just so much money there?
Yeah, this is a reasoning that I love. I think so. I'm in a few like fintech communities, and I tend to discuss like my favorite place to discuss DeFi and crypto is not in the crypto community, but is in the fintech community. It's really like the place where a lot of like conversation happens, and I think, and I also think like the level of pushback is better in those communities because it tends to be less focused on the ideal world. And a little bit more on the today of fintech, right? Today and tomorrow. So I like that aspect. And I often say this that you just mentioned, which is first, financial products are built for few, and these few are the most experts one. Whether you mentioned institutions, it could also be like professional investors and people who know who do that as a primary job, and then someone comes and wants to expand it to the next class, to the next class, to the next class. There is this amazing book which is called how the middle class society joined the money, right? And it provides a lot of examples around the history of Bank of America, then the history of credit cards, and then the history of financial products. And essentially you're seeing the same thing now with like Robinhood, which is they take something that was considered like kind of professional only before, and it's now like one click, you buy stock, you buy Tesla, and you are a billionaire oftentimes. So I think the enterprise adoption, I think this, like if you and I had this podcast like 6 months ago, there would be like way more uncertainty around the answer here. While I think we now know that enterprises are starting to adopting, institutions are starting to adopting Bitcoin and perhaps like some Ethereum in some forms. I had multiple conversations with asset managers, and all of them told me that they've never seen such a high interest in Bitcoin investments and crypto investments in general. And even for the institutions who are not necessarily like putting the money yet, it's becoming way more common that a CEO of a certain company organizes a meetup around like investing in crypto and brings in some experts to let them know how that works. It's really becoming popular. So all these asset manager, I think this innovation that you asked me to discuss here is really happening right now at an asset management level, right? So what is the way for an enterprise to buy Bitcoin, put in the balance sheet? What is the process? What is the accounting process to do that, and so on and so forth? So the answer is absolutely yes. Now, The part that I'm still a little unclear about, or maybe more unclear is like uncertain, is around how institutions will access DeFi.
Mhm.
And I think the idea is that DeFi first needs to evolve a little bit better into the direction of providing a little bit more, actually less volatility, more protection for funds, and um, more transparent, even more transparent way of how this interest rate is generated. Again,
Mhm.
like DeFi is very transparent now from a standpoint, you can read the transactions, etc., but you don't really know what forces move the market, right?
Mhm.
It's
Mhm.
still very unclear whether these movements are generated by few people like moving a lot of money, or generated by just sentiment. Like those mechanics and dynamics are still not clear. Like technical analysis, even though there are a lot of proponents of that, I still, when I talk to people, like I still feel very conflicting like theories.
Mhm.
Um, so yeah, there is a little bit more evolution that is needed there. What I generally think is that the fact that you can control your own money, you can get settlement in no time, you can compose like the composability properties of DeFi of your tokens, and the programmability aspects of that. I think these four elements are going to be really big in attracting enterprise adoption. I think the
Mhm.
first part, one theory I have is that we are going to see an explosion of um, uh, programmable APIs for dollars first,
Mhm.
and the fintech and the crypto world will converge on that, and then at that point we'll say, okay, if all these things are true, if I can program a dollar, if I can um, um, go towards this direction of like self-driving money, etc., at some point people will say, why do we need that central, like that party that sits in between me and my money, right? Like what is the need to do that if I can program everything? Do I need them just to say yes, that's okay, I protect you? And that goes back to what we discussed before. So I
Right.
think the convergence is around like self-driving money, and on the fintech world that will converge with the idea of like decentralized money on the DeFi side.
Yeah, I mean, I think you said it. You said it best when you said that, even if you look at the fintech world, why did innovation in tech start with the enterprise users, the power traders? Because they knew how to take advantage of it. Like the retail trader didn't need all these powerful tools because they didn't know what to do with it. And when you're an enterprise, when you're an industrial, when you're an institutional trader, you know how to take advantage of all these complex tools. So that's why I've always wondered. I feel like with DeFi, um, you know, because it's such a volatile market, because it's so new, there's so much inefficiencies that you take a real institution, a top trader at a Morgan Stanley or one of these guys, and I feel like they would be able to take advantage of all these crazy arbitrage opportunities and flash loans. I mean, give them these advanced tools. I mean, obviously they have to first understand how DeFi works and in the coinomics works and tokenomics. But I mean, once you already have these guys who already know how to take advantage of a financial system, of taking advantage of the smallest arbitrage opportunities, and then you give into their hands flash loans, you give into their hands the fact that oracles aren't so good yet, and you're able to take advantage of slippage and all these things. It just seems like once institutions come in, one, at the beginning, they're going to be able to just take advantage of all the inefficiencies. But two, because they're such smart traders, they'll actually, as a result, make DeFi more efficient market and make DeFi less volatile and actually bring, all the issues we're saying, what's stopping institutions from coming into DeFi. I think it's like a chicken and egg. Once they come in and all that money comes in and all that smarts come in, it now gets rid of all those problems.
Yeah, so I think I think here there are a lot of building blocks or a lot of aspects that will lead to this chicken and egg problem, or that will solve this chicken and egg problem. I think um, so. Let me approach this from the technology standpoint first, and then we'll switch a little bit more towards the use cases. From
Mhm.
what concerns like the technology standpoint, I think the first thing that we're going to see is the interoperability of these many layer ones that are supposed to power a lot of the applications in the blockchain and DeFi space. So So for instance, like Ethereum has done a ton, and without Ethereum probably wouldn't even be speaking here. But at the same time, they have, like, the network has structural problems that is causing some of the aspects that you just mentioned, right? One thing that I believe is underappreciated as a risk in DeFi is really that like basically all the money in DeFi, it's somehow like allocated to like collateralized lending, vaults, and places where you can put the money, get some leverage, get some exposure, and then given that it's algorithmically traded, the only parameter that allows the liquidation aspects to kick in is really whether the Ethereum to dollar or collateral to dollar price goes below a certain like threshold, which causes one issue in the market, which is I already know at what price people would sell their assets, and it's also inexpensive. Sorry, it's also very expensive to change that parameter, because every transaction on the Ethereum network like costs a lot of money, especially when you start stacking all this. So to some extent, unless you are allocating a lot of money maybe to a like investment product, the cost of rebalancing that portfolio or like paying an additional fee or the fee for an additional transaction can also be 100, 250, sometimes like it's been even higher than that. And the cost of doing that, it's very easy to understand that the cost of doing that is prohibitive and doesn't allow people to take like immediate decisions if the pair, let's say Ethereum to dollar like drops or moves in an unexpected way, right? So what is the problem here? If I am a self-incentivized trader who wants to make a lot of money, I would operate in a complete transparency of information, which means I would already know like what is the amount that is allocated to DeFi now. I think it passed the what is that? Is that like, I mean, it has been growing a lot.
I don't know. Crazy. I mean, I know there's like 3.5 billion in Aave. There's more in Maker. I don't know the exact number, but it's got to be.
Yeah, I think it recently passed the, I mean, given the Ethereum price, but I think it already passed the 15 or something like that, right?
Let's see. Anyway, 26 billion.
Yeah, here you go. Here you go. Ethereum did this all-time high in the last few hours, so that's also why the number keeps growing. But anyway, what is the idea here? The idea here is I can look at the transactions. I can look at all the collateralized debt position transactions, see what is the collateralization factor, and essentially start causing movements to drop the price of Ethereum to then to then benefit from the all automatic liquidation, which will lower the price even further, right? And who is absorbing that cost? The users who are not that reactive, are not that expert, are not into that game, or cannot afford to pay $150 in price, and you end up losing like 20-30% of your assets in 1 second, right? When I say 1 second, I really mean like 10 hours, right? Which is crazy. Which is a branch with your friends, and so what happens is this problem of transparency, in my opinion, is becoming way more evident than what people thought it would be like a year ago. Not just because of this like narrative around privacy that is a human right and all those things, but really because it's causing some fundamental issues in the DeFi space. The first one being the one that I just described, so the fact that self-motivated traders can look and plan accordingly, and the second one that is I can easily copy everyone's trades, offer more, generate a market for gas, and then the fees of the market tend to go up, and then scares away the masses, right? Or the least sophisticated users. So
with zero knowledge, I mean, that transparency problem on trades, it is really an issue, and something you highlight that's very smart. With zero knowledge proofs in programming these lending platforms or whatever, pretty much putting under the hood of DeFi, using zero knowledge proofs to both allow the protocol to run and work and operate as it's operating right now, but protect the details of the actual liquidation price or whatever it may be from people copy trading or taking advantage of it.
Yeah, that's right. So zero knowledge proof is one way to do it. It's fast for simple type of computation. So it's definitely a massive step forward, and I think it's going to become growing in popularity. I'm personally not a great fan of privacy at layer 2. I find it somehow like a paradox, because you want to put your most sensitive information on on a second layer. So I don't fully agree with that approach. And I also know that um, these like roll-up solutions are having a fundamental trade-off between like scalability and privacy. So the more you want to scale it, the least privacy you can offer. So I think that would be another things to solve. But what's becoming more and more evident is what, for instance, like Oasis, given that that's who I represent, has been solving since day zero, which is this privacy aspect of blockchain, where privacy doesn't mean hiding a lot of the things from like governments or users. It's not like a privacy coin in that definition, but it enables developers to keep some data or some inputs private and some other public as they wish, as they want, as they want to keep the promise with their users, as they want to comply with their regulators, whoever they want to satisfy. And yeah, I think that will be at its bare minimum, it will solve some of the fundamental issues that blockchain and even more so DeFi are having right now, which again are full transparency in a sense that everyone can manipulate the market because of this excess of information, high transaction fees, which has a straight line to, it's harder for large, like small, like mass adoption, but it's also harder for institutions to join, given the level of manipulation that is possible, and given the fact that it's basically impossible to create any reputation system unless you start like keeping some information private and you start connecting an idea of like identity and completeness of the actions to a protocol such as Compound or other DeFi protocols.
Mm-hmm. All right. Well, I mean, Luca, that's unfortunately all the time we have, but it is always exciting to speak to you, because I feel like you really had your finger on the pulse of both what's the issues facing the further expansion, because you are that product guy, but as well, you have a very deep understanding of these concepts. And so it's always a pleasure speaking to you, Luca. I'm looking forward to it. Till next time. And for all our viewers here at Reimagine 2021, I'm Yonah Hochhauser. Thanks for watching.